So, Michelle, are we expecting any of your cohorts?
No, you will just have
Just you?
my presence today.
Okay, then we won't delay any further. People can shut off their phones. And happy Flag Day. We'll call the meeting to order. Is Justin here?
Not here.
Okay, we'll call the meeting to order. Happy Flag Day. And why don't you join me in the Pledge of Allegiance? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay. The first item of business is the minutes of May 17th. Do we have a motion?
I motion we accept the minutes
I second.
as presented.
Second.
Okay. And somehow I think we all know each other, so I skipped over introductions, but let's start with Michelle, just for the TV audience.
Oh, certainly. Michelle Holton from Merrimack Village District. I have an updated chart of our capital reserve.
Okay, we'll get to that later.
Oh, okay.
Next.
Just going around, sorry.
You're up, Judy.
Judy?
Judy Noel, Cambridge Trust.
Eric Jusome, Cambridge Trust.
I'm Chris Christensen, Chairman of the Trustees.
Jack Balcom, trustee.
Bill Wilkes, trustee.
And Tom Boland, Deputy Finance Director and Treasurer for the town.
Okay, thank you all. The minutes are done, and I guess the first thing then is Merrimack Village District. And did everybody get an agenda? Does anybody need one? And there's some donuts here, courtesy of Cambridge Trust.
Good
Thank you
friends
very
at
much.
Cambridge Trust. And they're delicious.
Speaking in the plural, does that mean you've had multiples?
No. I haven't even completed one yet.
I just have an updated chart of our
Great, thank you.
rolls.
Thank you.
You're welcome. We just made a
I think
couple
we've
of.
seen this.
Pardon?
I remember seeing most of this before.
Yes.
Yeah.
We just made a couple of small updates. The mainline extension instead of July, August. We won't need that until August. Bless.
Excuse me.
So this remains largely the same. As far as the petition warrant articles for the 2 additional treatment plants, all we have on here is the 285.5, which will be for the design phase, and we'll be looking for reimbursement for that in January 2020. The other funds, we're currently in the process for grants, loans, and possibly bonding, but we don't anticipate having to draw any additional besides the 285 from the capital reserve funds. There is one other item, the treatment plant that is currently underway at wells 4 and 5. There will be additional costs. We don't have an exact number on that yet. It could run 800,000 to $1 million. We're waiting to hear back from the engineering firm that we're working with, as well as the bid process is just underway. So we want to see where things fall. So
Will you get reimbursed by St. Gobain for that eventually?
eventually yes. There's,
I mean, how does the agreement work with them as far as any overruns or that sort of thing?
right now the engineering firm is analyzing the overruns to see if they're related to, we had a certain agreement with them, then we had some add-ons that we did for ourselves. So there's some additional funds on both sides. So I asked them to break that out and see where things fall, and then they're also going to see how the bidding comes in. We will go back to St. Cobain, but the timing, obviously, of working that out is unknown. So there may be some funds that we have to put out during the process in the next year, because it is underway. So I'll have more.
But these add-ons weren't required in order to do the filtration?
No, there was the agreement there was an agreement for the plant. Then, since that was being done, there were some things that we wanted added on, and we've already, that was $810,000 that we added on to the entire project, just for extras, preferences, things that we had since there was already gonna be something underway. And we've secured a matching grant. So we put for 405, and we're getting a grant match for 405. As things have actually started to get underway, we realized from the pricing from a couple of years ago that we based the agreement on, and some changes, once things have started to get underway, there may be an additional 800,000 to $1 million needed. Right now, the engineering firm is working to break that out to what is related to our add-on in the original St. Cobain agreed piece. As I said, we'll connect with St. Cobain as far as the additional costs related to what our original agreement was based on, the timing of when funds from them would work out is unknown. And as I said, we're underway with the project right now over this next year. So we may need to draw some funds from capital reserves. Like I said, we're not sure on the numbers yet. We should know more information in the next 2 to 3 weeks, and we'll touch base, but we wouldn't anticipate needing to come to capital reserves at least until January or later, because there'll be some work done before the winter, and the bulk of things will kick in after winter. So we may have something from these first 6 months that we would request a reimbursement for, with some flexibility, and then following winter, when things get underway, there will be additional funds. And I'll just have more information when we hear back from everyone, and we'll let you know. But that's the only other item that is out there.
Yeah, we're mostly worried about the next 6 to 12 months, since we have to time
Yeah, definitely the next
the
6 months.
rollover of CDs and
Okay, the next 6
other
months we're
items,
good.
so
And as I said, in the next few weeks, I'll know additional information, say for next January going forward into the summer, as far as what our needs may be regarding that project.
And we have about 3.8 million in the equipment facilities fund, although we're gonna spend $100,000 that in a few minutes.
Yes, I was
173,000.
gonna say.
Nevertheless, the funds are there. It's just a matter of timing on the rollover of whatever vehicles we're using for investments right now.
Yeah, we don't, like I said, we don't anticipate anything this year. Possibly, maybe a quarter of that we might look for sometime over the winter for reimbursement for this first half, the second half of this year. And then from following winter through to the summer, when the plant will come up, will be when we would be looking for possibly some additional funds. We are also gonna be looking for, perhaps a grant, other funding sources. But like, as I said, right now I don't know specifics, but I will let you know as soon as I do.
Okay. From the investment side of it, Judy, do you or Eric have any thoughts? Can you use this as a working document, or do you need something more specific from us?
We can use this, yeah.
Use this.
Yeah, yeah, not a problem.
Okay, so we'll take that as advisory for cash flow needs and turnover. I guess rollover of investment vehicles is a bad image when I used that earlier. Sorry about that. Okay, what else do we have from the MVD? We have a request someplace in here for $173,000. $98,880 for a backhoe replacement. And we have the paperwork, we have the documentation, and then 75,000 for
Artificial recharge.
engineering study for that. Yeah, exactly, thank you. Artificial recharge.
Yeah, right, that's the study.
So, I think that money's already been expended, so it's just a matter of reimbursement from the Equipment and Facilities Fund, if somebody wants to make a related motion.
Is that right, Michelle? It's already been expended?
Yes.
Okay. I'll make a motion to release those funds.
Second.
Okay, is there any further discussion? Seeing none, all in favor? Signify by
Aye.
saying aye. Aye. Motion carries 3-0-0. So we will get that in the works
Thank you.
momentarily, or this afternoon, or over the weekend, whatever. I don't think we have any, do we have anything else from the MVD?
I don't have anything else to review.
Anything else that you want to bring up, Michelle?
No, I don't.
Okay. Well, we certainly thank you for coming here. Appreciate the spreadsheet. That helps a lot.
No, I'll definitely, and I'll keep doing that, updating it as we go along, because we will have quite a bit going on in the next couple of years.
Great,
Yep.
thank you.
Yep, good luck.
Thank you.
Okay. So, the next is our general fund management. And I'm just going to turn the floor over to Judy and Eric.
Okay. Great.
We have some handouts here. Did everybody get one?
Everybody have the book?
You wanna stay, or you can look at, you know?
Will you be going over our funds as well? or-
Yep.
Yeah,
Well,
we do.
Actually, yeah.
we
Yeah,
go
we-
over,
We do an
everything in
economic
rigid
and market
detail.
outlook, and we go into all the separate accounts.
Oh, actually, I will stick for this piece.
yeah.
And if you have- if you
It's a
have
lot
any-
more interesting here than it is to watch it on TV. Get to ask questions.
Thank you.
Eric, are you going to do this, or Judy?
I'm gonna
Whatever.
do it.
Okay.
I'll do it. So I'm gonna start on page 4, not to go through every page, but sort of set what's going on in the market, set the theme and how we've been, relaying that into the portfolio. So we've had a very good start to the market as far as stock market returns, erasing all of the fourth quarter declines from 2018. Year-to-date through Wednesday, the S&P 500 was up about 17%. So really strong start to the year. And interest rates have actually declined. Right now, when we are at the end of 2018, the Fed talked 2 to 3 rate hikes coming into for the balance of 2019. They have since reversed course, and actually the bond market right now is as measured by the probabilities of Fed future cuts and hikes. Right now, the bond market's expecting a 75% chance that the Fed will actually cut rates at their July meeting. When you move out to the September to December time period, you're closer to the mid-90%. And if you factor in all those different factors, it looks the bond market right now is expecting 2 to 3 rate cuts through next year at this time. So complete 180 from where we were about a year ago, and a lot of it is related to the trade wars with China, as well as you're starting to see, the overall global markets are starting to slow as far as GDP growth goes. In a couple of years in the past, we've talked about what was called synchronized global growth, where all economies were growing rapidly at the same time. Quantitative easing was starting to come off the table. The Fed went through a tightening program. Now there's more and more talk of synchronized slowdown. So the world economies are starting to slow. The U.S. economy, I wouldn't say it has slowed, but it's not growing at the torrid pace that it was in 2018. First quarter GDP was very strong at 3.1%. You're starting to see second quarter estimates are more in that 2% area, which is still, relatively strong growth. It's just not as strong as what it has been. And part of the reason is on page 4, just looking at, putting this into historical context, the title, The Record-Breaking Expansion Chugging Along. So this was as of March 31st, we're now 120 months into this economic expansion. And on the right side, the strength of the economic expansions, this current expansion is the bottom blue line. So it's one of the longest in U.S. history, but as measured by cumulative GDP growth, it's one of the most subpar. So it's been a very elongated recovery, where we've had a couple quarters here and there of strong growth, then we have a couple of quarters of weaker growth. And again, there's been a lot of talk in the press of inflation, of a recession. Some strategists are talking recession coming in 2020. We don't see that right now. And again, a recession is characterized by two consecutive quarters of negative GDP. And right now, we still have positive growth. It's just not the strong growth that we've been seeing. And turning to page 5, this kind of puts it into perspective. You look at the global manufacturing activity. So it's very color-coded. And the way to read this is green is good. Light green is still okay. When you move towards the yellows and reds, that's where those global PMI indices are below 50. So again, PMI indices above 50 signal an expanding economy, below 50 a contracting economy. And a lot of the contraction you're starting to see is really happening in the emerging markets. And part of that is the trade wars or the trade tariffs that have been imposed on China and the ripple effects that are starting to happen in those emerging economies. But notwithstanding that, on page 6, first quarter was off to a really strong start. We've shown this table in the past. So if you look at year-to-date and Q1 are obviously the same. So you go going across the table to large cap value, large cap blend, growth. So all sectors are very strong returns. Large cap growth up 16% for the first quarter. Your 3 portfolios that have equity exposure have more of a value blend, more of a value tilt to them, and even still, those are up almost 12% as measured by an index. So overall, really strong returns to start the year. We've had some pullback, especially in May, where the market was down, but overall, the markets are still strong. And on page 7. I think, a lot of investors think the market goes up every day, or it seems to have. If you go back to 2009, since the March 09 lows, the S&P 500 has tripled. It's up over 300%. So the market does not go up every day. Each year there is volatility, and just if you look at over on the far right, the year to date, so through Q1, the market was up 13%, but it was almost at its lowest point, it was down 2%. If you look back one column to the left, that brings you into 2018. So the market at its lowest point was down 20%, and that was that fourth quarter pullback, and it finished the year down 6%. So overall, there is volatility. We think volatility is possibly going to be here for a while. Obviously, we have a very contentious trade wars going on. It looks like Mexico has been resolved. China's going to have 25% imposed on additional services, about $300 billion. So China's starting to feel the ramifications of these trade tariffs right now. A lot of companies are starting to move production out of China to Taiwan, and it's actually some production starting to come back to the U.S. So, right now we've talked to several strategists as part of our due diligence that feel that Trump in order to win re-election, I don't want to make this political, but this don't shoot the messenger. This is what some conventional wisdom, conventional logic is thinking, that Trump needs a trade victory in order to win re-election. And the longer this drags on, it's actually going to start to slow U.S. growth as well. And it's not that they have a trade treaty signed, let's say January 1st, January 2nd, the economy grows. It's a lagged effect. So it takes 2 to 3 quarters for this to actually impact. So a lot of strategists are thinking that the G20, Yi's not going to come out right away and say, I'm meeting with Trump, because he has his own political agendas, that they will have a sit down, they will meet, and there will be some sort of an agreement. It may be a wink, handshake, nod, but there will be some sort of a framework for a trade deal. And if China actually obeys it is the other story, but Trump needs some sort of a victory in order to win re-election, something he can campaign on and doesn't drive the U.S. economy into a recession, which right now we don't think the U.S. economy is heading towards a recession. There will be a soft patch or a slowdown, but again, you're coming off of higher levels. On page 8, part of the reasons,
How much of the volatility
Sure.
do you attribute to computer trading?
How much of it?
Yeah, I mean,
Fair amount of algorithmic trading. So you have a lot of I'm not saying
you can say the the trade wars and all that thing, but, I mean, companies have been moving to Vietnam long time before this trade war.
Yeah.
Because it's cheaper to produce in Vietnam and other countries in the Far East than it is in China, because China's whole economy has come up and their wage rate has gone up. So, I mean, a little bit of it's media hype, but I'm just wondering how much of this
I don't have the actual
is
percentage,
computerized trading.
but it's a fair amount of the volatility can be attributed to algorithmic trading, which is, the flash trading. You have all these computerized trading programs that look for, minuscule changes in prices, and they can rapidly execute trades. You flash back, go back 10, 20 years, and you would not have seen as much volatility. And a lot of the volatility is due to the proliferation of ETFs, or these passive products that mirror indices that rebalance on a frequent schedule. So if you have an index, let's say Apple is 3% of the index, Apple has a bad couple of days, it's now 2.5%. So you have all these indices or ETFs that are linked to indices that have to go in and rebalance. So you have a lot of moving parts, especially with these passive type products that are tied to indices that have to rebalance in order to stay within their mandates. So that brings into, the algorithmic trading. That's what a lot of these ETFs do. It's all computerized. There's not an active manager. I mean, there's a manager in charge, but there's no real stock research that's being done. It's just more quant type, algorithmic trading that goes into place. Turning next page to page 8, one of the reasons why we don't think the U.S. The market could have some volatility, but as far as valuations go, it's trading right in line with its 25-year average, so it's not overly expensive. Flashing back to December of 2018, December of 2017, the market was trading almost 1 standard deviation above its mean. End of 2018, it was almost getting about almost 1 standard deviation below its mean, and now it's right back to its mean. So it's not overly expensive. There are some pockets that are a little rich, but overall the market as a whole is not expensive. So we don't see a bubble coming from, for a recession to happen. We don't see a bubble in the stock market right now. As I mentioned earlier on page 9, if you look at this chart, the grayish line is the S&P 500 return. So if you go back to the March 09 lows through March of this year, S&P 500 has returned 319%.
Okay.
So you had a really strong stock market. At the same time, international markets have lagged. So the international markets are only up about 100%, a little over 100%. So pretty big dispersion there. And the portfolios have about a 15 to 20% international allocation right now. Page 10, this gives you an idea of S&P 500s with the most revenue exposure relative to the S&P 500, just to give you an idea of what those returns have looked like. You can see after the first round of tariffs, you've had the pretty substantial pullback, and just as of the latest tweet a couple of weeks ago, you've seen those pull back even more. So it's definitely a hot topic. As I mentioned earlier, we think at some point there will be a resolution. Again, if Trump wants to seek re-election, he's not going to win re-election with the U.S. economy in a recession. He needs a strong U.S. economy and some sort of global victory in order to at least have a chance for re-election. On the next page, on page 11, S&P 500 company exposure. So these are the 500 S&P 500 companies with the most revenue exposure to China. And just to highlight, out of the companies that are listed there, the portfolio only has exposure to Chevron, which is an oil company. So again, the portfolios as a whole, if you look at a global, the 80-20 index, so 80% S&P 500, 20% of the MSCI ACWI US, that's what we measured a global benchmark for. That has about a 1.6% exposure to China. The portfolios are about 1.4%. So we're still underweight China versus a global benchmark. And most of that exposure is coming through some of the active, like Matthews funds that we use, as well as the emerging market iShares. So we have no direct company investments within China.
This is good news. Is there any particular sector that's actually benefiting from these trade wars?
Any particular sectors? It's hard to say. I think overall, oil companies were benefiting, but as China slows, there's less demand for oil. and, you know, some of the natural resources are starting to slow as well. So I think it comes down to, you know, what the profitability of the companies, with the tariffs, it's an inflationary impact to the U.S. consumer to start with.
Okay.
Is how much of that can the company pass on to the consumer?
Most of these companies on this list
Are tech related.
are tech related.
Yeah.
So if you believe that we're gonna all get rid of all of our technology,
It's hard to
then
believe
you don't
it's
wanna
gonna
be
happen.
in these companies, but if you wanna, you know, everything's moving 5G and everything else, so
It could be an opportunity,
Could
you know,
be.
the portfolios aren't, you know, the design of the portfolios is not to is to have dividend paying stocks in the portfolio, and a lot of these tech companies don't pay dividends.
But we do have Texas Instruments in the portfolio, and it has a pretty good dividend.
Yes,
You
yeah.
mentioned that, you mentioned Chevron.
Yeah, I believe we sold Texas Instruments. We may have trimmed, or we've in the process of reducing Texas Instruments. More because, not the China exposure, but more of what we're seeing as semiconductor weakness in the U.S. You disagree?
I wouldn't have done it, but you guys are in charge.
He's a former employee.
Oh, sorry.
They make every nut and bolt that goes into every computer or system you can imagine.
I'm just jumping ahead to look at the portfolios that would have that exposure. We've been trimming the stock, and we still have it. It's still in the
I
portfolio.
mean, semiconductors in general, and not talking about Texas Instruments, are pervasive. Everything you can imagine
Yeah,
has
it's- yeah.
semiconductors in it.
Yeah, I know.
So,
Yeah.
you know, long term, you're just gonna, I mean, everybody wants more bandwidth.
Mm-hmm.
Long term, and somebody like Texas Instruments makes literally every computer, every device that has electronics in it has a TI chip in it. Because they make a broad range of products.
Yeah, yep, exactly.
So, I mean,
I think it's
would be-
more, you know, profit.
I'd look at you know, a downtrend in semiconductors as an opportunity. Not
We
as-
are doing additional
I
research on
mean,
that
they're not
sector.
making buggy whips.
No, they will be around. They will continue to be a player in that space, correct. Just on the next page, speaking of tariffs, so after Q1 earnings calls, more and more companies are starting to mention China tariffs as part of their earnings call. So you can start to see some of these are the consumer companies with Best Buy at the top there, working your way down to some tech companies as well as consumer companies. Overall, it's getting more and more press, and the longer it drags on, you're going to start to see companies starting to impact their profitability.
So retail's still good.
Well, I wouldn't say it's still good. I mean, it depends how much of that gets passed on to consumers. So if prices increase, will the consumer actually buy it or hold off and force production to slow, at which point the company's price will have to lower prices in order to sell the goods.
Okay, wow.
Turning to page 14, now talking about interest rates. So the yield curve has inverted. So if you look at the 3-month to 10-year is one of the more popular metrics to look at. So the 3-month to 10-year is inverted by about 10 to 15 basis points. It was in the mid-20s a couple of weeks ago, so that inversion is less inverted. And one of the more popular metrics is the 2 to 10 spread, and the yield differential between the 2-year and the 10-year Treasury. That's still positively sloped. That's about 24 basis points positively sloped. Historically, when the 2-10 has inverted, about 14 months on average before the U.S. economy moves into a recession. So it's one of the more popular metrics. But again, short rates are anchored by Fed activity. So short rates have not come down as much. They have come down. But long rates have come down more as a reflection of the lack of inflation in the economy right now. So CPI is underwhelmed. The Fed has this 2% inflationary target that is well below a 50-year average of 3.5%, and that we have yet to get to 2%. So the Fed has this target of 2. We're nowhere near 2, and actually inflation has actually come down in 2019. So if you look at break-evens, which is what the market is pricing in for forward inflation, for 10-year forward inflation right now, the market's pricing in about a 1.75% inflation, so well below the 2% level. And long rates are also dictative of growth. So we think the latest has been more of that flight to quality trade with everything that's happening in the global markets. It's been the flight to quality, especially to the 10-year Treasury. So the 10-year Treasury is yielding about 2.1%. 3-month T-bills are about 2.3%. So that's that inversion in the yield curve right there. But again, if the Fed does cut rates, it may have the propensity to actually re-steepen the yield curve. So the market, as I mentioned earlier, is basically telling the Fed you need to cut rates. And the Fed's listening. It doesn't mean just because the market wants them to cut rates that they will. They have a mandate. They're supposed to not be paying much attention. They shouldn't be the anchor that drives stock market returns. The Fed has a dual mandate of low inflation and full employment, and you could say we're pretty much there, as the unemployment rate right now is 3.6% and inflation is low. Our feeling is the Fed doesn't need to raise rates, and they probably will cut rates at some point in Q3 or Q4. And typically when they cut rates, it's not a one and done scenario. They usually have multiple rate cuts in. So it could be 2 to 3 rate cuts. But again, the yield curve has inverted.
We don't have much room to cut rates right now.
Well, they have a little room because the Fed funds rate is in that band of 2 to 2.5, 2.25 to 2.5. It's trading at about 2.37. So they can go back to the zero bound, which where they were for many, many years. But the economy, again, we're not falling off a cliff. And I think there's been this overhyped reaction to market volatility, the drive to quality in U.S. Treasuries. So typically the 10-year Treasury is a reflection of GDP growth at year end. So if the U.S. economy grows at 2.5%, GDP, the 10-year Treasury should move marginally higher from where it currently is. So we think rates, you could have a re-steepening of the yield curve. But on page 15, it takes what I just mentioned. If you look at this column, so going down on the left side as the meeting dates, you can see the probability cut for hike probability is 0 going all the way out to a year from now. You can see the cut probability. So you move out to that July meeting, it's an 83% chance is what the market's expecting based on probabilities that the Fed will actually cut rates. And if you move down to the individual columns, it gives you an idea of the rates. So right now we're at 2.25 to 2.5. But if you move out to the 1.5 to 1.75 target, you can start to see as we move out towards next year, there's a higher probability that the market's pricing in the Fed will have in that at least 2 to 3 rate cuts by next year. Again, this is a snapshot in time. Doesn't mean it's going to happen, but that just gives you an idea of where market sentiment is.
Yeah,
right
this is
now.
an amazing chart.
Not always accurate, but at least at the moment in time, it gives you an idea of what the market's expecting, or what the market is pricing in. One thing we really haven't talked about and the bond market really has not paid attention to yet is the federal finances. Record deficits right now, record Treasury issuance, still a lot of demand for Treasuries. So, the auctions have been going fairly well. But if you move out, looking at the bottom chart on the right, federal net debt as a percent of GDP. As we move out in 10 years from now, we're going to be at a debt to GDP ratio close to 100%. We're looking more and more like a third world country. So if this was Venezuela, you wouldn't buy it. But because the U.S. government is considered the safe haven and has never defaulted on its debt, we're considered the safe haven and can demand low interest rates. But again, it's that marginal interest rate. So U.S. Treasury, 10-year Treasury is 2.1%. Germany's negative. Japan's negative. You have a lot of foreign government bonds that are trading near 0 or slightly with a bandwidth of 0. So on a relative value basis, U.S. Treasuries at 2.1% look attractive.
Yeah.
And just lastly, as I mentioned earlier, on page 17, inflation remains in check overall. So you look at the black line, so that is the core PCE deflator, and the measure is measured, it's still below. If you look at the 50-year average, averaging 3.5%, in January it was at 1.4%, so well below a 50-year average. And again, the Fed's targeting 2, which we have yet to get to 2. So with that, we can start looking at the individual portfolios. So that kind of gives you an idea of where we're thinking. We don't think that we're going to head towards a recession. We expected more mid to high single-digit stock returns for the year. Obviously, we're much higher than that through almost midway through the year. we still think you can generate still positive, you know, returns going forward from the stock market. A lot of it is going to come down to what is the actual multiple. You know, if earnings were were strong for Q1, earnings estimates have been increased. So if you look at $182 consensus estimates at 17 times earnings, you can, or 16 to 17 times earnings, you can still generate 2 to 4% returns from here out. But the first account up is the scholarship account. Just to quickly go through it, if you look at the market value, it's about $243,000. This is as of June 11th. Asset allocation is about 66% in stocks and 24% in bonds and about 10% in cash. Is there any withdrawals that are needed from this at the moment?
No, most of the scholarships go out in the spring.
Okay,
$1,000 roughly for the Lego League in the fall.
okay,
You know, minimal
okay.
type stuff, all pretty much the same every year. The Gibson Fund, there's a little bit of pressure to increase that. We gave out $3,500 last year, and we made about 4,000.
Okay.
Some time ago, the original donors of that fund really wanted to give out $6,000, and we said, well, you know, that's not a sustainable kind of thing right now. So we stuck with the 3,500, but there's always a little pressure to give out more, and yet we need to stay within that range of making a little bit more than we give out, so that we have
So just, yeah.
some cushion for a year when, for whatever reasons, we don't make so much. The question I had on that was, we appreciate that we're getting a lower management fee on that, but because it's a small fund, the opportunity for diversification is a lot less than it is if it were part of the larger portfolio. So the question was, if we move this into the common funds, would that be advantageous in terms of a better return or security because of better diversification? Or are we pretty stable because we know that everything is predictable?
I'd say it's pretty diversified. We're actively managing the portfolio in line with the you know, principal and income funds. So it's a very similar mix of stocks. So we have about 30, you know, we have about 45 stocks in the portfolio. So I think the returns have actually been strong. Even though it's a smaller portfolio, it's still individually managed. I'll leave that up to Judy as far as putting into, you know, the common fund. But if you just look at the returns, going back, turning to the next page on page 19. So looking at the account as a whole, you know, the account year to date's up 9.8%. The 1 year is the trailing 12 months, it's up 7.6%. And since inception, it's annualizing going back to November of 2012. So 6.5 years, you're annualizing almost a 7% return. So I think the returns have been strong, even though it's a smaller portfolio. It has grown.
Okay.
And just turning to page 20, you know, how we generated these market returns. So this brings down, it's mostly coming from the equity side, as obviously stock returns have outpaced bond returns. And the bonds are actually in a mutual fund strategy because of there we really can't achieve any profit diversification because of the size. So it's in mutual funds. So a lot of the sector returns are coming from, you know, the stock returns. If you look on page 20, the way to read this is you look at the variation weight and the variation of returns. So it'll show you where we're overweight or underweight those specific S&P 500 subsectors. I think 8 out of the 10 sectors we're invested in, the returns are better than the subsectors. So it's coming down to stock picking. So some really good stock picking in these sectors has helped generate the returns. And this is over a 12-month time period. If you look back at the chart on page 19, you know, the equity returns over the last 12 months are up 8.73% versus the S&P 500 at 3.78. So about a 500 basis points of outperformance over the last 12 months. And against that global benchmark, again, that 80-20, the differential is even greater. You're looking at almost a 700 basis points in outperformance versus an 80-20 benchmark. So again, it comes down to a lot of, this individual stock picking within the portfolio has been very strong.
Okay, thank you.
Yep.
Move on.
Move on to water. So that starts on the next tab on water on page 26. So cash and enhanced cash is about 1.5 million. About that, we were leaving about $500,000 in cash, the rest to be invested. Again, a lot of it is just we had some recent maturities, inverted yield curve. We're trying to, it's tough to buy a two-year security when the 3 months yielding more, but we want to at least roll out the curve a little bit and lock in case rates do decline from here.
And what's our return on cash?
Return on
Is
cash
there any?
It's actually 2.24%.
Okay.
So sitting in cash is actually yielding more than a two-year treasury, two-year security. But again, we feel if the Fed does cut rates, the cash returns will come down. So if the Fed decreases or has a cut, 25 basis points, money market rates will, within a lag time period, drop by 25 basis points.
That's still so much better than a couple of years ago when
Well, they're paying 1 basis
cash was a
point.
loser.
Yeah, cash was paying 1 basis point.
But they are coming down already.
Yeah.
Yeah, I mean, most were in a 2.25 range. Now you're starting to see them head more towards 2.20 as the 3-month Treasury has declined. So by their new mandates, they really can't roll out the curve. They have to keep a certain percent, very liquid and basically in floating type, 30-day to 60-day paper. And as those come down, money market yields will come down. So if there is an actual rate cut, you'll see those come down even faster, or with a lagged effect. So within a month or so, you'll start to see all money markets would reprice to the lower interest rates.
Still a lot better than a couple of years ago when we were just plain scared of cash.
Well, at that point, cash was
Yeah.
earning 1 basis point or 10 basis.
Do you have anything, Michelle?
Okay. Again, the returns have lagged. If you just turn on page 27, that's more towards duration. We're showing against the Bloomberg Barclays 1 to 3 year government index, which has a 2-year duration. And the duration of this portfolio is about 1.4 years. So we're underweight duration, again, because of the cash, expected cash needs in the portfolio. We're just rolling out 1 to 3 years. There's no questions. Turning to municipal. Again, very similar story here. Cash and enhanced cash is about 4.2 million. Again, enhanced cash includes securities with less than a 1-year maturity. We're leaving 500 liquid, and we have about $1 million to spend into the market right now.
And later on this morning, they're gonna be asking for $2 million.
2 million? Okay. So we have, the cash is available. And when would that expected withdrawal, when would you need the money?
Monday.
Okay.
Well, we just wanna get the transaction completed
Yeah.
before June 30th.
Okay. And again, very similar story across the portfolios. Returns have lagged the index more because we're underweight duration as designed because of liquidity needs. School on the next tab on page 39. Cash is about 460,000. Again, in this portfolio, we usually leave about 250,000 liquid. That leaves us about 70,000 with which to invest that we're looking to put into the portfolio right now. Next one is income. So this portfolio is a market value of a little over $3 million. Asset allocation, we're about 65% in stocks. The balance between bonds and cash, 30% in bonds and about 4% in cash. We're still, mandate is a 60-40 type allocation, so we're a slight overweight to equities. So I make, we're still comfortable with that slight overweight. We want to make sure that the committee is as well.
I'm fine with it.
I'm good, but if I were gonna move, I'd move towards 65 instead of 60,
Okay.
just as a rough sense of direction, but that's personal.
On page 46, so very similar returns to what we saw in the scholarship account. Look at year-to-date, the portfolio in total is up 8.5%. Equities are up 11.8 versus the S&P 500 of 10.7. And over the trailing 12 months, returns are 7.14% at the total portfolio level. Again, stock returns are 7.8 versus the S&P 500 of 3.78 and the global benchmark of 1.8. So again, it's all coming from, individual stock picking within the portfolio.
And I think you have been pretty successful.
Yes,
with all of that. I'm pleased with it.
Again, and the mandate of the portfolio is for dividend-paying stocks, so I'm just gonna turn just to highlight, if you look on the next page, on page 47, so the portfolio is underweight tech. Reason being is a lot of the newer tech that, the FANG stocks don't all pay dividends.
Right.
So each stock in the portfolio has to pay a dividend, and by our research indicates that dividend will continue to grow. But even still, this is over a 12-month time period. If you look at your variation of returns, so your portfolio's returns for tech were up 22%. The benchmark was up 4% over the last 12 months. So again, not having that exposure to FANG is not hurting you, at least over the last 12 months. So big, recognizable, dividend-paying tech companies, Microsoft, Cisco, Apple, ADP, Accenture, these companies have generated really strong returns. And during periods of market volatility, we see Salesforce having a bad month, not having exposure to those names has really helped these returns.
Amazon.
Well, you're talking apples and oranges, though.
Yeah.
I mean,
Yeah, it's
the FANG stocks are kind of like overpriced in simple terms from a PE standpoint,
They're very
valuation
overpriced, yeah.
standpoint. But Microsoft, Cisco, they're pretty much
Reasonably
in line
valued.
with the market.
Yeah, they're reasonably valued, but again, some of these tech stocks, they're trading at 50, 60 times earnings on hopefully earnings that continue to grow. Otherwise, if they don't, you're going to see those stocks pull back substantially. But again, this portfolio's design is for, has a lower beta than the market to be more conservative. But what I'm trying to say is even though it's more conservative, it's not hurting your returns whatsoever.
Do we have any Chipotle in there?
You do
Talk
not.
about
no.
an overpriced stock.
No Chipotle, no.
Pardon me
No.
while I choke on that one.
100 and some odd times earnings.
Well, that's before the next food poisoning, so.
Oh, there you go. Yeah, I was curious, and I don't want to pick on particular stocks, but I was noticing 3 weeks ago, Lucan had an IPO.
Who did?
And Lucan,
Okay.
coffee company in China.
Yep.
And we own Starbucks, which I don't like, but I'm into it emotionally rather than being, this is a Dunkin' Donuts town. They've got 2,400 coffee shops in China. They're going to have 4,800 by the end of the year. Starbucks has 4,500 now, something like that. It's like they're just going to be butting heads. And in view of the unease of the Chinese versus American markets and so forth, that may be a typical company. Caterpillar would be one. Do we have other things that are tied up into that mix?
There's a lot of, you're looking at companies that have global scale, right? So it comes down
Yeah,
to
but a
how
lot of
much.
that scale is in China.
Yeah, I mean, Starbucks is expanding into China, but it still has a predominant, U.S. base, and very strong growth metrics as measured, especially in the U.S. So it's a stock that our analyst still likes. It's not a huge percent of your portfolio. It's about 2-ish% of the portfolio. We consider that as a reasonable holding for the long term. We also, we don't have exposure to Caterpillar. If you just jumping ahead to look at what the industrial exposure is on page 55. So Emerson Electric, Honeywell, Union Pacific, Watsco, and Xylem. So not a lot of, especially from these individual companies, not a tremendous amount of China exposure. Especially Union Pacific and Xylem, which is more U.S., especially U.S. domiciled, U.S. based.
Yeah.
So you can see more of your tech companies. Accenture obviously has in Apple has actually moved some production out of China as it's too expensive right now to manufacture some of the iPhone components over there. Again, Cisco, Microsoft, Texas Instruments, they do have international and global sales. So I think, there's still, there's the fear of, if these trade wars lag, what it will do to the, the profit margins of these companies. But right now, they're big, they're large, they're multinational, so they're not I mean, they do have China exposure, but it's not enough to, cause, a 40 or 50% pullback in some of these names.
Wow. Seems to me this would benefit Taiwan quite a bit.
Well, you're starting to see companies move production to Taiwan, yeah.
I know they make a lot of semiconductors in Taiwan.
Well, Taiwan Semiconductor, yeah.
Yeah.
That's been a pretty good company in itself.
Yeah, definitely. has been.
Amazon still looks pretty good.
Amazon doesn't pay a dividend.
Not for this portfolio.
No?
Yeah, and Amazon doesn't pay a dividend, so it's not held. It's held in some of our other equity strategies. Not to make it an Amazon story, but Amazon is, it's going to be, it's the wave of the future. Everything's going to be, more and more. The brick and mortar stores are folding because of Amazon's able to drive them out of business, drive the competition away with lower cost.
Well, Amazon just really radically moved towards private delivery people rather
Yeah,
than...
they eliminated their contract with FedEx. Yeah.
Exactly,
I
yeah.
think Walmart's giving Amazon a little run for their money though, right?
Recently
now.
they have been,
Yeah.
yes.
They've really
They've upped their online.
re-engineered themselves a little bit,
Correct,
and
Well, and I understand Target's trying to do the same thing, so
yeah.
we
I mean,
shall see.
More and more, I mean, the younger generation is less apt to go to buy something at a Target or a Walmart. They're doing more of the online stuff. It's more convenient and it can be shipped next day, or depending upon, where you're, what they're.
which Walmart offers now, and they offer the ability to just drive through almost,
Yes, exactly.
pick up your item in some of the newer stores or redesigned stores.
Exactly. So Walmart is still held in a couple of these portfolios. That's a legacy name that was before we started managing it, and we still hold it, still like the company. Again, you have a lot of companies need to reinvent themselves. You look at Sears was unable to do that. So retail is a very tough sector. There's going to be, the survivors are the ones that can re-engineer and redevelop to stay within what, society's needs are.
One of the best examples of reinventing yourself is Microsoft.
Correct.
They've done a fantastic job, and their stock reflects it now.
Yeah.
They're the highest capitalized company in the world now, right?
Exactly, yes.
Mr. Gates got a little richer.
Still, Walmart's, the yield on Walmart's about half of what it is for Amazon.
Well, Amazon doesn't pay a yield.
Doesn't have a
Have a
yield.
yield.
It says, oh, yeah, but it's a strong stock and it's, the current yield, 3.56%.
That's a bond.
That's a
That's the
bond.
Oh,
bond.
I see, okay,
Yeah, so we own the debt in this portfolio. We don't own the actual stock.
got it.
Yeah.
Okay. So that's why,
Yeah, the bonds are listed on the top of the page.
Cisco's done a good job too of reinventing themselves.
Yeah. Oracle had less so, but
And
Cisco
that
had.
stock is reflecting their reinvention too.
Yeah. That's, if you look at your tech holdings, it's gonna be very similar for the principal, which is the next account, but the tech names are starting on page 56. Again, Cisco, Microsoft, Texas Instruments, Visa is not a credit card company. It's actually, they own the network that makes all the transactions. Accenture and Apple, so really large, tech companies in your portfolio.
What do you think about next, I guess, Chris, we're not supposed to talk about individual stocks, but NextEra Energy, it's pretty, has a pretty premium price.
It's expensive, but they're also developing, they have a wind division, so we like it for the fact that it's a diversified energy company. It's not just solely a fossil fuel generator. So they do have alternative energies, which, if you look at, the Democratic candidates, there's several talking more of, the greener deal going forward, of less reliance on fossil fuels to generate our energy sources. So we think, NextEra is well positioned in that regard. So it does have a higher multiple or higher premium because of those reasons.
And a 3.5%, 3.2% dividend, something like that.
Nextera it's actually come down a little bit because of the increase in the stock price, about 2.5%.
It's over $200 a share now, I think.
It's based on this price, it's about $202 a share.
Anything else, Tom?
I was just curious, some of these items in the other equity category, the Matthews Asia Dividend Fund and Emerging Markets ETF. I mean, you just feel like we should have some exposure to.
Yeah, so Matthews they're an on-the-ground manager in the Far East emerging market area. And we think that the Asia dividend is a attractive area to be invested in. Again, it meets the mandate of dividends for the portfolio, but at the same time giving us some geographical exposure. And the iShares Emerging Market ETF, again, that's more of a passive product, so it's a different mix of companies and sectors and countries within those two different products. But we feel that, it is a global market. It's, we feel we do need to have some global exposure. And again, the portfolio is, the benchmark is an 80-20, and we're closer to that 20% than we are. And we've actually increased it a little bit this year. As one of those prior charts showed, international stocks have lagged. We think, even though there's a lot of noise in Europe, we're not fully on board with Europe yet, but just the emerging markets. There's volatility, but we think there's also opportunity there as well, and that's why we want the active manager, Matthews, managing that for us.
Anybody else? Good presentation, thank you.
Thank you.
Judy, do you have other stuff to?
Well, you have our spreadsheets updated through May 31st.
Yep.
We are on track for the June 30 conversion. Once the information is updated, we will upload it to the Axiomatic website and notify you once we have gone through and verified that the upload was successful. Trustees will then go in and review and actually approve it, and then that's the requirement for the filing. It'll be fulfilled by the September 1st deadline.
Yeah, our meeting related to that, I think, is August 23rd. It's in the agenda.
August 23rd.
Yep. At which point we will also be renewing or discussing investment policy. So if you have
Is
anything.
that something you want us to attend?
No, you don't have to attend, but if you have anything. that you
Changes.
Look at the investment policy and think ought to be adjusted, this is the time we have to do it because we have to turn it in by September 1st.
Right.
Okay, we do have a couple of other issues here. We have correspondence from the town looking for money coming out of the insurance capital reserve funds. Have one of those, one for Bill.
Chris,
Yes.
are the originals from what I had emailed you for the
Oh, okay.
releases, so I just brought that along.
Oh, this is from you?
I think that's for you, yeah.
Great, thank you.
Very good, well, good to see everyone.
see you.
Thank
Take care now.
Michelle.
Have a good day, Michelle.
Thank you.
So, from the insurance funds, looking for 7680 and 6113, total 13,794, 16.
There's not currently any money in the property casualty fund. We're also gonna be delivering a check to fund that account for $10,000 this week.
So let me,
And then
Here's the
asking for a bunch of that
copy
to
of
come
that
right
letter
back
as
out,
well.
but.
One for each of you.
Yeah.
So I think maybe we need to get this completed by June 30th. We need a motion
Okay.
to approve pending deposit of the $10,000.
I move we approve the pending of the issuing of the $10,000.
Is that gonna be enough? I mean, didn't you say there's
There's all-
nothing in the account?
There's nothing in the property casualty
Oh, okay.
one. The liability account has about $15,000 in
Okay.
it, so, there will be enough.
There's a zero balance in
I would
the
second that.
CRF, yeah?
We'll second that. Moving $10,000.
Any further discussion? Anything to add, Tom?
Not unless there are questions.
Okay. Motion, all in favor?
Aye.
300. And then we have, I just got it, wait a minute. I'm not gonna read you the whole list, but we're looking at, 2,064,729.24. Is that the correct number, Tom?
No, that actually includes the insurance stuff. That's the
The
2,050,935.
I'm sorry, yep.
Yeah, you already included the 13.
So, we need a motion. Do you guys all have that letter?
Yes.
Okay.
So it's the $2,050,935.08.
Is that a motion?
Yeah. If that's, Tom, is that the correct, that's the correct
It is.
rate?
Yeah.
Okay. The 8
Per
cents,
the-
class.
Per the attached list, I guess also pending signed requests from the town manager or the assistant town manager, whoever's supposed to sign it.
I will second that. If that's a clear motion, can we have a clearer motion for the TV audience?
You
Motion
want to just
to,
restate it, Jack? Thank you.
motion to approve the sum of $2,050,935.08 to be given to to issue a check to the town for set amount.
Okay. Or a wire transfer. I think we usually do a wire.
Why? Well,
Yeah,
however you transfer
done by
the money.
wire.
Any further discussion? Anything else you want to add, Tom?
Again, unless there are questions, it's all fairly, it's just reimbursing the town for expenditures that have already been made.
Yeah. It's pretty well itemized on the town's letter.
And this is the backup with all the supporting invoices. I
Right.
didn't kill any more trees than I had to.
Does this go in the annual report?
That request itself,
Or a list of?
This letter doesn't, but the individual accounts show the transactions in and
would
out.
show, right.
And
yeah.
what they were used for?
The detail is probably not in the annual report, no. We maintain it at our files. If anybody wanted to review it, it's available to be reviewed.
Yeah, because some of this is like sending somebody out to buy 20 shovels for the DPW, and it just gets lumped into the $3 million, whatever it is. So I wouldn't expect that level of detail to go into the annual report.
As long as it's available, if somebody wanted to see it, I'm fine
And
with
it's
it.
also reviewed by the auditors, as part of the annual audit process.
Help me out, we've got new auditors, what's their name again?
Graham and Graham.
And have you folks had any contact with them from other towns?
What's
Graham
Graham
and
and
Graham.
Graham.
CPA.
Auditors, CPAs,
Yeah.
It's not a firm I'm familiar with.
okay.
Where are they located?
They have an office in Concord, and they have a few other offices in the northern part of the state.
It's not a firm I'm familiar with.
Okay. Well, we got that motion on the floor for the
Right.
$2,050,000. All in favor, signify by saying aye.
Aye.
Aye, okay. Motion carries 300. And I think, let me just ruffle through here for a second, see if there's anything else that.
You had Watkins Prize Speaking Contest on the,
Yep, but we're still
oh, okay.
into
Oh, fund management?
transactions and so forth.
Okay,
Um,
thought we'd gone out of fund management.
Yes. We are moving on. So yes, the next item is the prize speaking contest. We went to that last Monday morning.
8 o'clock.
You missed the,
How was it?
it was,
Very good.
the quality was excellent. It was back up to where it was when we last, really when it was in full swing, before it went dark.
One of the teachers who was organizing it was a contestant
Nicole
in it
did,
when she was in the middle school. So that was an interesting touch. Tyler Pare is working with the students, so it's a good combination there. We had 5 well-qualified people.
Excellent.
And good program, so I'm tickled to see that going again. And I expect that we will get a check or a request for reimbursement in the neighborhood of $450. So if somebody wants to make a motion to approve reimbursement of that, since we don't meet in July,
I make a motion that we approve any reimbursement invoice that comes to us for the Watkins Speech Contest. What's really amazing is one of the last things before all of a sudden we didn't have the Watkins speech for like about 15 years, I guess.
I don't think, well, I don't know how long it was, but whatever.
Anyways,
It's nice to have it back.
one of the last things was a student memorizing the poem, Edgar Allan Poe's The Raven. That was the first thing that we heard on this resurrection of the speech contest.
Should we have a not to exceed on that?
500?
Yeah, $500 or something like that?
Okay, yeah, that sounds like a good boundary for that motion.
Is that a second, Bill?
Yes.
All in favor?
Aye.
Motion carries unanimously. Now we're moving into other stuff. We did get an invoice from the Flower Fund. Flower Fund's $118.50. We approved that in advance last month, so that has gone to Cambridge Trust to be paid. Morningstar Dividend Investor.
So it's just a subscription?
Well, we've sort of paid it. They had our credit card number, so they billed the credit card, but we didn't have an invoice. So we've got an invoice now for $199. Here's a couple of current issues. Oh, and I changed the codes for the password for the website.
Take?
I actually want to take one from you.
Sure. I'll take one too.
Want to take this, Jack?
Take whichever one you want, Joe.
That's the new password for the website.
No, you get first pick. No? Okay.
Pick whatever you want.
Take it.
I guess
Pick a winner.
I get one here for Tom, too.
Okay. Tom?
So the invoice is for $199. Do we want to approve that?
You want to take one, Tom?
Oh, okay, we didn't pre-approve this.
No,
Do we use it?
I certainly do.
Okay. I move that we approve the subscription to to the Morningstar Dividend Investor for $199.
Second.
All in favor?
Aye?
Motion carries 300. Do we have anything else coming in over the transom? Didn't see any other correspondence. Anybody aware of any? Future meetings, August 23rd,
Okay.
September 20th, probably.
Oh. See, August 23rd.
September 20th is a Friday, I assume.
Yes.
I have a wedding in Maine, but I think I'll be all right because probably leave right after the meeting or something like that.
Yeah, August 23rd, we'd already,
August 23rd's fine with me.
Okay.
it says investments, Poland audit? Is there a, Is
I'm
there-
not sure what you,
Well, it seems like you had something that was specific to the August 23rd meeting.
Investment policy.
Oh,
We have
investment
to-
policy,
We have
okay.
to adopt it.
Yeah, it's my
Yeah.
handwriting there, and then, okay. Adopt, okay. Yeah, and then September 20th. Okay, for some reason, I don't have that down already.
well, because we hadn't really scheduled it before,
Okay.
but it's probably a good time.
When do we review with Cambridge Trust again?
November? Does that sound right?
November.
Twice a year,
Good day.
unless there's something exciting going on.
Yeah, we can. When in
And-
November?
November.
Well, anytime Cambridge Trust comes, it's exciting.
Well, and you might get a hold of Mike Powers for the September meeting, see what he has to say. He's our forester.
Oh, wow.
Do you want to have a tentative date for November? Just, when is Thanksgiving this year? Anybody know quickly?
Thursday.
Third
Yeah.
Thursday in November?
I don't know, I don't have that with me.
Are we gonna meet in December?
I think not.
So
Unless you have-
if we pick the last Friday in November, if that isn't Thanksgiving weekend? Okay, so that won't work. The one prior to that?
22nd of November would be the one prior to that. The 29th is the last Friday.
People good with the 22nd? Does it work for you guys?
I'm checking right now.
November 22nd, huh?
Yeah, that works for me.
All right, as long as we're looking at calendars, do we have an October date?
Guess I could get my calendar up.
Okay. I'm still writing down November.
The 25th, maybe? Does that work?
Halloween weekend, sure.
Yeah, but that's not. Okay, so the 25th of October,
We would normally meet the 3rd, which would be the 18th in October.
I was just looking at the fact that we're gonna meet on September 20th, and I'm
Yep.
thinking 30 days out, maybe, I don't know. Either, at this point, it doesn't matter. for
Right.
me, whatever you wanna do.
okay, so the 18th to the 25th of October, when's the November one?
22nd.
22nd, okay, so either one really.
I think the 18th
18th? Okay,
is more typical of when we meet.
okay, if that's our normal meeting.
Subject to change. Okay, do we have anything else exciting that we want to talk about?
I gotta go put up signs for the Rotary Club, so
Okay?
I would motion that we adjourn.
That starts today, right?
This is a
That's
different sign
Ribfest.
project.
He's talking July 4th.
Okay.
Ribfest starts today, yes. So, 9:45. All in favor?
Aye.
Aye.
Thanks a lot for coming.
Yeah, thank you.
Very
Thank you.
informative.
Thank you.
You need extra copies?
Thank you for the.